Greetings, risk management friends. I am Wendell Bosen, Corporate Risk Manager for Alsco Uniforms. Risk management helps make our communities better places to live, work, and play. Risk control helps prevent and reduce losses, while risk finance helps pay for losses that occur. I consider myself a blue-collar risk manager. And what I mean by that, I, on a daily basis, do the stuff you learn in the Certified Risk Manager CRM classes. I work with claims daily. Last week, I participated in disaster recovery business continuity tabletop exercises. Next week, I fly to London, where Lloyd's helps us with our property insurance program. I have meetings scheduled with brokers, TPA, and insurance carriers. I have been in risk management in one form or another for almost 40 years. My first job out of college was with an insurance carrier as a loss control trainee, where I learned to be a safety consultant. I was well on my way into being a industrial hygiene and an ergonomic specialist when I completed the ARM, the Associate in Risk Management program. I fell in love with the whole concept of risk management, especially the interrelationship between risk control, think safety, and risk finance, think insurance. I decided that rather than continue pursuing the CIH, Certified Industrial Hygienist designation, I would pursue an MBA. And I went back to college at night. I consider risk management to be my career calling. My resume includes 6 years as the Risk Management Services Team Leader for a public entity's liability and workers' compensation insurance pool, 8 years as the Director of Risk Management for a company operating Job Corps centers and private prisons, 4 years as a risk management account executive for a regional insurance broker. I am in my 5th year as the Corporate Risk Manager for Alsco, an international uniform rental and industrial laundry company, which is, incidentally, over 135 years old. I want to share 2 examples of risk management practice which I have, I believe, successfully used, and I am currently using also, I believe, successfully. Number 1, large deductible insurance program, and number 2, total cost of risk, or TCOR. When I was hired as the Director of Risk Management at MTC, that's the Job Corps and Prison Company, I was able quickly to use some of the risk management lessons taught in the CRM analysis and the CRM financing of risk classes. MTC's casualty program, including general liability, auto liability, and workers' compensation, was a large deductible plan which seemed to have deductibles too small for a company with over 10,000 employees and revenues close to $1 billion. The deductibles were only $50,000 for general liability and $100,000 for workers' compensation and auto liability. Within my first year, based on tools found in CRM classes, I was able to clearly see that we could and should significantly increase these deductibles. The premium savings were greater than the predicted losses. It was that simple. With the help of my broker, we were able to convince senior management to agree to increasing the deductibles to $500,000 for each cover. Oh yeah, I was anxious. There were definitely some sleepless nights. I knew if we had a normal loss year, we would save money. But I also knew we were taking on more risk, and if we had an outlier bad year, we could end up paying more, much more. But I believed we were making a risk-informed decision, and thankfully the first year was better than normal, and we were able to clearly show a savings of $2 million on a budget of $11 million. I would like to expand on how we were able to quantify the annual savings of $2 million. We used the concept taught in the CRM classes of total cost of risk, or TCOR. Not exactly the same definition as the classes use, but we focused in on the casualty program. For us, the equation that we used was TCOR equals casualty premium plus casualty retained losses plus risk management budget. We ignored coverages like property, professional liability, and surety bonds. That helped simplify the calculations and I believed added to the accuracy. So here are the main two takeaways. Number one, for some organizations, a large deductible program can produce significant savings by not trading dollars with insurance companies, increased investment from cash flow, and, in my opinion, most importantly, providing a strong incentive for risk control. Takeaway number two, total cost of risk, TCOR, is a simple and effective tool to quantify the cost of risk management program. If you are still watching this video, congratulations, you are almost certainly a dedicated risk management professional. As you do risk control and risk finance activities, you are helping to make our communities better places to live, work, and play. And for that, I sincerely say thank you.